Welcome to Coffee and Regs, a CSS RegTech podcast series on moving from a tactical to strategic approach to regulatory compliance.
Hi, this is Natalie Silverman for CSS. Welcome to our next episode of Coffee and Regs. On today's last episode of the year, we're recapping the world of investment monitoring in 2021 and looking forward to what's next in shareholding disclosure, sensitive industries, and position limit monitoring in 2022. Please welcome CSS's Regulatory Content Manager, Greg Hotaling, and Product Manager, Mike Marmo. Good morning, Greg and Mike, and thanks for sitting down for Coffee and Regs.
Thanks for joining, everyone. Greg Hotaling here with CSS. I'm here with my colleague, Mike Marmo. Today, we'll talk about very quickly some of the things that we've seen in investment monitoring in 2021 and what we expect in 2022. So happy holiday season, everybody. We're transitioning from 21 into 22 and taking a look back, but also taking a look forward a little bit as well. Mike, did you want to say a few words about yourself for an introduction?
Thanks, Greg. I'm Mike Marmo. I'm the product owner for our investment monitoring tool, primarily dealing with shareholder disclosure, position limit monitoring, and sensitive industry monitoring. And that's pretty much what we're going to go through today is sort of what to look forward to in 2022, both from a regulation side as well as operation and compliance. So with that, Greg, I'll hand it back to you.
Yeah, that sounds great. Thanks, Mike. So, a lot, investment monitoring, you have a lot of different things to consider: position limits, substantial shareholding, sensitive industries too, as you said, Mike. The way I look at sensitive industries, in some ways, it's the most challenging of all. Either your disclosures to be made for sensitive industries, or even more commonly, the limits, the maximum levels at which you can invest in these particular sensitive industries, be they media, telecommunications, military, forestry, whatever industry is deemed sensitive or especially protected by a government agency around the world. Those are varied. There's so many of them. You have to deal with different agencies around the world to understand the regulatory approaches. So it's kind of an existential challenge. It's always challenging. I think today, what we're going to do is just tick off a couple of the big matters that have occurred in substantial shareholding and position limits only. And we'll leave sensitive industries to the side, Mike, if that's okay, unless you wanted to add anything.
No, that sounds good, Greg.
Okay, super. So let's look at a quick sketch of the important matters that have been going on in 2021. We'll start with substantial shareholding. In the EU, we saw a temporary lowering of the EU short selling regulation disclosure threshold. That was in effect for a few months, from 0.2 to 0.1%. That can be especially burdensome for your compliance departments because the deadline, I'll remind you folks, is the very next trading day at 3:30 in the afternoon local time. That threshold is to be lowered permanently to 0.1%. So no longer just a temporary measure. Currently, it's back up to 0.2%, but it will go back up, we expect, to 0.1%. Any day now, really. It should be approved by the EU Parliament and Council, and then it will appear in the official journal, the sort of regulatory register for EU purposes. And 20 days after that, it will go into effect, the lowering of the threshold. And that, by the way, will affect your interests on regulated markets and multilateral trading facilities. A little bit different than the temporary threshold lowering we saw, which only affected your interests on regulated markets. At the same time, there's also, in a parallel development, a more broad changes to the EU short selling regulation being contemplated, not yet finalized, by the EU, including position calculation methods. So the method by which you need to calculate your holdings, we expect that to change as well. But that's a broader set of changes that hasn't been finalized yet, whereas the lowering of the threshold we expect to be finalized very, very shortly. Mike, did you want to say anything about how you've seen asset managers, compliance departments, and operations respond to these kind of developments and how they should respond?
Yeah, I think, in general, when you're leveraging either an automated solution, something like CSS's investment monitoring product Signal, or using, an in-house proprietary solution or another vendor solution, I think really any asset managers with short exposure in Europe for the jurisdictions that fall within the ESMA guidelines should really understand what jurisdictions their exposure is between that sort of 10 basis points and 20 basis points short exposure. Similar to the folks that are, remember and are aware of the COVID measures that were instituted, there's going to be a large increased filing volume. Some asset managers actually don't like to have that exposure where they're required to file and obligated to file on the short side. So a couple different pieces with this is number one is obviously know what jurisdictions that you potentially have exposure to when these updated thresholds go into effect. That will first prepare you for any filing obligations that you need to make in those jurisdictions. The second is really, if you are an asset manager that does not really kind of avoids that obligation exposure is to start to think about unwinding some of that short exposure to avoid the notification obligations, which we've seen, investment guidelines and investment guidance within these asset management companies go a couple of different ways with that. So I would say, obviously, the most pertinent thing to do is to understand where that exposure is and make sure that you have a plan in place, whether it be to increase your availability for filing or whether it be to start to unwind or reduce some of your exposure on the short side within these jurisdictions in Europe. Knowing that it's going to come and knowing that it can happen really any day is really the best advice to give from an operational standpoint.
Interesting. Yeah, thanks for that, Mike. It's interesting you mentioned that, finding out the jurisdiction in which you have to file can be a challenge. On the regulatory side, we've been asked quite often, we have these short exposures in different markets, on multiple different markets, maybe in multiple different jurisdictions, either in the EU or in the EU and outside of the EU for things like cross-listed securities. And it can be difficult to find out sometimes where you actually have to make the filing. Of course, you might end up having to make the filing in multiple jurisdictions. If, for example, you have a short position that's cross-listed in the UK, which is no longer a part of the EU, and in the EU as well. So, but that's just one of the many complications you can run into. And obviously, like you said, if the threshold is lowered to 0.1%, it's just, you're going to be running into these issues all the more frequently. And then let's remind the listeners or viewers as well that once you hit 0.5%, your short position is made public. So that's important too. That particular threshold won't change, the public one. So, at 0.1%, you'll still remain required to file with the regulator and not the public. But like I said, 0.5% is that threshold for public disclosures. Let's move on to position limits. And we can look at some EU developments with regard to position limits as well. In some ways, it's actually similar to the EU developments for the short selling regulation because you have a particular change that is going to affect quite soon, and then you have a broader set of changes to position limits. So I'll explain that. MiFID II is undergoing some changes in many respects. One of those respects is with regard to position limits. On February 28th, 2022, it's expected that the coverage of position limits in the EU will narrow. So what I mean by that is that the scope of commodity derivatives to be covered by the EU position limit regime, all 30 EEA countries, will narrow to certain commodity derivatives that are deemed significant. So either agricultural commodity derivatives or other types of commodity derivatives with at least 300,000 lots of open interest. Those will be the focus of EU position limits starting on February 28th, 2022. That's a narrowing because currently EU position limits cover essentially all commodity derivatives, basically. That provides some relief to EU markets, to market participants. It's meant to, in this sort of, if you want to, we called it the COVID economy. It's helped to provide some support to struggling commodities markets in the EU. So, a little bit less of a regulatory burden, particularly for energy markets. So some of these commodity derivatives that have energy underlyings, electricity, gas, oil, for example, will not be subject to position limits. Again, unless, of course, they have at least 300,000 lots of open interest. So ESMA, and Mike, we've talked about this before, but ESMA has decided that, we don't want to wait till February of 2022. We think it's important that this relief be provided currently. So ESMA cannot change EU level 1 rules, but what they can do is, and they've done it. To me, it's a bit of a bold move. I haven't seen it before, but they've suggested to national competent authorities in member states not to follow these position limits that will go away in February. So basically saying, look at ESMA's quick fix directive, and instead of assuming it will apply on the 28th of February, assume it applies now. And how can the member states do that? Well, they can refrain from enforcing those limits. So they can basically say, we're going to follow ESMA's suggestion. Even though the limits may still be on the books until February, they can say, we're just not going to enforce them. And you can get into a sort of separate academic or legal debate about whether that should be done. But certainly it's being done. Early adopters of this suggestion in the EU were the CNMV in Spain, BaFin in Germany. So in some of these countries, you can check the position limits there, and the listings for the limits are a different set of products, a narrower set of products than you would have seen if you had checked there before ESMA's suggestion. So that's interesting. And then, like with the EU short selling regulation, there's also a broader MiFID II development for position limits going on here as well. ESMA has recently finished consulting on some other changes, including applying for position limit exemptions and also changes to the calculation methodology that NCAs must use in order to set their position limits. That's something that's subject to a set of parameters under MiFID II, and that's going to change as well. The new, for you legal eagles out there, the new RTS with respect to those changes is RTS 21A. So we've been talking about RTS 21 for a few years with regard to position limits, but now this will be RTS 21A. Mike, so, like I said, we've discussed this before, and for you listeners and viewers, you can consult our website and see podcasts, blogs, vlogs, you name it, webinars on all these issues with Mike and I included, but other folks as well opining on these things. But Mike, if you want to recap on sort of how you see asset managers dealing with these issues, or again, how they should deal with them.
Greg, it's certainly an interesting proposition from with the quick fix proposal. I think one of the things being us in the reg tech space primarily dealing with compliance. The tendency is to take a conservative approach, and I think that stands true here in my opinion. Ultimately, what we want to do and what I would advise the clients of our investment monitoring tool, or even clients monitoring this proprietarily or on their own sort of accord, is to comply with these limits that are set until actually adopted and enforced by the relevant NCAs. And I say that, you may even decide to do that in a soft limit capacity, something akin to an accountability level, something where you're continuing to monitor it until it's actually in enforcement by these NCAs. And you had mentioned, Germany's BaFin, so the European Energy Exchange. They're
Right.
one of the ones that have adopted these. And I think at that point in time, from my perspective, it's safe to then adopt that as an investment manager, right? But obviously, with the fact that this is MiFID and governed by MiFID, but also enforced by the NCAs, I think it really is prudent to take the NCA approach and really follow this from a monitoring perspective in line with accordance to them until the relaxation of these limits is enforced by those NCAs. And so, that's the advice that I would give to investment managers monitoring this. I would say when that particular NCA or that particular exchange actually does enforce or confirm the relaxation of those limits, I think it's safe to pull your foot off the gas in terms of monitoring those. Until then, I do suggest that it's prudent to monitor those, even if it's in sort of a soft limit capacity or an accountability sort of level, type capacity.
Makes sense. So like you said, an example would be the EEX, the European Energy Exchange based in Germany, where they have specifically said, yeah, we're going to follow ESMA's suggestion. And their list of position limits doesn't have those other products on it anymore. It just has the limits for the narrower scope. And so then it sounds like what you're saying is, and I think I agree, it's safe once that happens. But before the NCAs make that public announcement, you might want to play conservative, meaning
Right.
follow all the limits. Yeah.
Right. And to further your other point, Greg, I think it's really imperative that, folks that are monitoring this stay close to the follow-up point, which is the calculations may end up changing, how you net, how you aggregate that netting across exchanges, within exchanges, certain underlying products. All of that you really need to stay closely in tune to, because I think that could fundamentally change how your exposure is derived with respect to these limits. And so while that's not clear right now, I think that's something that folks really need to kind of keep a close ear to. If that's something that, if you're actively monitoring in this space right now, it could potentially change, significantly change your exposure to these particular limits. So
Yeah, sure. So that RTS I mentioned with those broader changes, including position calculation changes, that's expected to go into effect on the 28th of February, the same date as the narrowing of the scope of the limits. So it's all expected to go into effect on the same date. So let's move on, because there are other position limit developments in the USA that I think are noteworthy. They involve, and a lot of listeners and viewers here will know about this, because the CFTC has been going back and forth with a proposed position limits regime change for more than 10 years since the Dodd-Frank Act. They have finally finalized it. This happened, I believe it was October of 2020. It involves staggered compliance dates. So the first compliance date for this change to the position limit regime in the US is the 15th of March, 2021. First compliance date, 15th of March, 2021. The next compliance date, 1st of January, 2022. The third and final compliance date, 1st of January, 2023. So let's go over very briefly what those compliance dates mean. So the effectiveness of the regime change happened on 15th of March, 2021. The important thing, if you're an asset manager holding interest subject to position limits on U.S. markets there, is that the position limits for the 9 core contracts that are covered by the CFTC rules have changed. Actually, what's interesting is that most actually are less strict. There's actually some leniency there. The position limits on those contracts are sort of less strict than they were before. But as always, check the exchanges. So the CFTC sets position limits that the exchanges must follow but the exchanges can be even more strict if they want to. So the exchanges can't be less strict, they can be more strict. So it's still worth checking the exchanges on US markets, like, for example, CBOT, Chicago Board of Trade, or CME Group, NYMEX, COMEX, Minneapolis Grain Exchange, these U.S. markets that have products, some of which are subject to these CFTC specific position limit levels. So it's always been 9 reference core contracts, but it's expanding under this new regime to 25 core contracts. So 16 additional reference core contracts. And there are some more agricultural derivatives there, but we're also talking about derivatives with underlying energy commodities and other derivatives with underlying metals as well. So a broader scope of underlyings. Like I said, you have 25 core contracts now affected by these position limits, on which position limits must be set and administered by the exchanges. The limits on these 16 additional contracts is going into effect on the 1st of January 2022. They're for the spot month only, so you don't have your single month and all month limits. What's interesting as well here is that the exchanges, before this goes into effect on the 1st of January 2022, the exchanges had actually set stricter limits than what the CFTC is requiring on the 1st of January. So the exchanges, many of them have actually relaxed those limits in anticipation of the rule change of that compliance date on the 1st of January. It's another reminder to check the exchange limits. Don't only check the CFTC limits. So those spot month limits on the 16 additional core contracts, like I said, go into effect on the 1st of January 2022. And then the third and final compliance date, the 1st of January 2023, is when you must include swaps in your relevant positions. So we're not just talking about the classic instruments that have always been subject to CFTC limits, like futures, options, but now you need to include your swap positions, swaps that are economically equivalent to any of those 25 referenced core contracts. And also, you need to include swap positions in your exchange-listed products that are subject to exchange position limits. So again, worth reminding viewers and listeners here, if you're not too familiar with the CFTC's regime, is that the CFTC sets limits on 25, used to be 9, now 25 core contracts. But the CFTC also sets sort of limit parameters on other types of derivatives that the exchanges must employ. They don't set hard limit levels for those other contracts, but they tell the exchanges to employ limits, and the exchanges have to do it under certain parameters set by the CFTC. So for those exchange limits, we'll call them, the CFTC has also said you must include your swap positions. That's by the 1st of January 2023. So Mike, we've discussed this in a lot of detail in the past. What's the reaction from your end of things?
Greg, I think this has certainly sort of been a long time coming. This has probably been years in the making for expanding the scope of products that are sort of under the guidance of or under the application of these limits from the CFTC. I think historically there's been a bit of a comfort in the fact that the CFTC was limited in scope, that the exchanges and the CFTC were really very much in line with the limits and how they applied them, which, again, sort of allows for a bit of comfort here. I think the paradigm is going to shift slightly in the fact that we've now expanded to 25 contracts, like you mentioned. And it's even more important than ever that you're making sure that you're staying up to date with those exchange set limits, because, on the heels of the MiFID II discussion, similar to how MiFID II and the exchanges have set their limits for particular products, they can differ, and they can differ quite varying. Not to say that this is going to be the case initially when we roll out this phase of the new products here, but I think it's going to be more important than ever to understand and to keep track and to monitor the exchange limits versus what the CFTC limits, particularly if you are a U.S. listed commodity trader, where, again, you knew the 9 products like the back of your hand that were CFTC related. Now we're going up to 25. We're expanding, what type of commodities these are actually going to cover. And so I think from an asset manager perspective, it sort of behooves you to really kind of pay attention to this with a fine-tooth comb and understand where you may have this exposure, where you may have exchange setting stricter limits than the particular CFTC, albeit, it sounds like the exchange will sort of lift their limits or ease their limits to what the CFTC will be initially. We can't say for certain that's going to be the case going forward like it has been in the past. So I think from my perspective, that's one of the main things to keep an eye on, one of the main things to evaluate. Again, whether you're sort of using an automated system like CSS's signal system or you're using a proprietary process or software, I think it's very important that you communicate with your operations team, your compliance team, and most importantly, the trading and risk team, in order to make sure that they understand that these limits are in effect, if particularly you're trading on them, and that not only are we looking and facing exchange limit application, but now obviously more broadly a regulatory application in the CFTC.
Yeah. also, particularly since on the exchanges, the number of products listed, we've been making references to the former 9 core contracts and now to 25. But if you look at the different products and the different variations in which those products are split up and listed, we're talking about thousands of products listed on exchanges that are subject to either the CFTC hard limits or to general exchange limits. When you look at especially the CME group, the CBOT, the NYMEX, the COMEX, you're sourcing a lot of information there. You're not just talking about a handful of products. So that's something to keep in mind as well. That makes the task all the more difficult. Oh, also, I think we've discussed this in the past too, Mike. This has been kind of another matter that we had discussed separately. The fact that the CFTC rule requires aggregation of similar products listed, I should say derivatives with similar underlyings or what's deemed to be the same underlying listed on multiple exchanges. That's an interesting thing too that the CFTC will require, even potentially listed on exchanges outside the US. If it's decided that your derivative that you hold has an underlying that's similar to a derivative that's subject to position limits in the US under a core reference contract, then you have to count that derivative or aggregate it with the reference contract you're already holding. But that gets complicated because sometimes it's difficult to know whether the derivative you hold, let's say, on JPX in Japan, or the derivative you hold in another US market, or wherever it may be, a London Metals Exchange. Sometimes it's difficult to tell whether that's really the same derivative and should be aggregated or not. It's kind of complex, right?
Yeah, and obviously to add more complexity there is the intricacies of whether it's physically or cash settled, right? I mean, you can add that layer in as well, right? So this is all the broadening or the aggregation across exchanges really only applies when these underlying, when the underlying commodity is the same underlying commodity and is physically settled on those markets. And so now you're adding a level of depth that we never had before. We never had to, I think, apply or monitor before, but certainly something that is going to come to the forefront. And I think, as 2022, progresses, you're going to see more scrutiny into the application of this and really how this is going to generally be applied across the market. So this is certainly a developing situation. It will continue to develop. And I think it could have ramifications on the swap equivalent application come 2023. So it's going to be an interesting year, I think, for positional monitoring and how those products are evaluated and aggregated together, both on the European side as well as the U.S. side. And so now more than ever, I think it's important if you're investing in these spaces that you keep your ear to the ground and make sure that you're complying with the necessary updates.
Yeah, good point. Like Mike said, check about whether those products are cash settled or physically settled, because that determines, whether you need to aggregate them. And again, I hope everyone here has found some, usefulness in this quick look at what's been happening in 2021 and what will be happening in 2022 with regard to investment monitoring. And wishing everyone happy holidays and signing off until we see you next time. Thanks a lot. And thank you, Mike.
Safe and happy New Year. Thanks, guys.
Thanks, Mike and Greg, for the insight into how you like your regs in the morning. For CSS, this is Natalie Silverman.
This has been another episode of Coffee and Regs, a CSS RegTech podcast series. Make sure you catch every episode by subscribing to our podcast on www.cssregtech.com or through your podcast platform of choice. Thanks so much for tuning in. This podcast is brought to you by Compliance Solutions Strategies and is for general information purposes only. All rights reserved.